All right, so why might you get into a strangle when it comes to trading options, or how does one create a position like that, and what's kind of the advantage to doing something like this? A lot of people get confused with strangles, so I'm going to share with you some insight about this and what's a common way to kind of get into a strangle. Maybe you don't even know about it, so stay tuned. All right, so a strangle is very interesting. It's kind of the baseline to selling option premium. So I want to show you kind of this stuff. And by the way, if you want to learn quite a bit more about option trading, check out the website, tradersfly.com. You can check it out and go to your browser right up there. We've got courses, membership, coaching 101 if you want to actually speak to me directly, and live schedule and live classes that we can do. And we've got a recent live class here for covered calls that we just did. Anyways, if you're looking at a strangle, and you're looking at, let's say we sell this one, okay, and then we sell another call over here. So we sell a put, we sell a call. Here is our basic strangle. Now, a lot of people hate this. They're looking at this and they're saying, what in the world are you doing? And why would you do something like this? And the reality is, you know, it has got a huge risk to it. When you look at the picture of the risk, you know, all the way down to the downside, stock can go to zero, right? I mean, the risk is pretty much, in the general world, it's classified as unlimited. But yes, for all those mathematicians and smart Alecs, they're going to say, oh, look, stock can only go to zero. Yeah, exactly. Stock can only go to zero. And here, when we can go to the moon, the stock can only go to the moon, right? Well, yeah, again, you got infinite losses there too. So unlimited losses upside, unlimited losses to the downside. So when we look at this, people always wonder, well, why in the world would you do something like this? Well, the thing is the reason you do something like this is because you get a fast theta. The problem to just doing it like this is you're kind of naked on it, meaning there's no protection, there's nothing there going on. So basically, you're pretty much naked on the stock and you could get assigned one way or the other. Now, I'm going to show you a concept of how this could come about in a trading strategy and situation where you could actually be in a strangle or get into a strangle if need be and necessary. So first, we're going to start out with buying 100 shares of stock. So let's say you get into a stock position, and let's just run through this as a timeline or word problem in the mathematical sense. We're going to go in and we're going to confirm and send that order. I'm going to put it into the play account, and this is paper money, so don't worry about it. I'm just showing you for illustrative purposes. Okay, so here we've got into this account, we've got some money going, and we've got some shares. So we got 100 shares. Now, a couple days go by, you could say, hey, I'm waiting for the stock to pop. Maybe it pops, maybe it starts dropping. You say, hey, I want to sell a covered call on it. Okay, so what you do is you might go 9 days, you might go 30 days, you might go 5 days, you might go 50 days. I don't know. But you go in, you say, okay, I'm going to sell a covered call. So I will go in and sell a single over here. So now I am basically capping my profits this way, right? So this stock, I'm assuming it's going to go to the upside, but I'm capping my profit. So I'm able to go ahead and make a little bit of money here for about $190 in premium from the upside, but that means I'll lose my shares. So I'll go in and I'll put it in there. So now I'm making $191 in premium at expiration. So there's 190. We got filled at 190. So I've got this contract right there. So there's my call. From a call side, I want it to go down. From the stock side, I want it to go up. Overall, I'm still 77 deltas long. So that means I'm positive up until this point. Now, here's what's cool and interesting. And when might you get into, let's say, a strangle? Okay, so here, I've sold the call, but let's say this thing starts heading higher. I'm about to lose the stock. I got 100 shares here. I'm about to lose them. And I don't want to lose the shares. I don't want to miss out on the exposure because here I'm kind of flatlined. Okay, so I'm flat right here. So from here, from this 245, anything higher, I don't really make any more profit. I do from the theta decay and the decay of the option contract, but from the stock perspective, I really don't because those shares will be gone. So I could say, okay, well, once we reach here, I'll just buy another 100 shares, but that's expensive. What if then, since the stock gets stretched, right, because now we're stretching, what if it pulls back? And then I'm left with now 200 shares. So what's a more conservative way of playing it? Okay, so here's what you could do. You could go in and sell a put. So we've already got a call sold at that 245. So here's our 245. We've sold the call there. So what if we do kind of a similar approach at the 220 and we sell something and we make about $200 right there? Okay, so let's do that, and this is where we get into our basically strangle, okay? Because now I'm thinking in my mind, I'm assuming, well, in this case, this stock, I'm gonna lose 100 shares, but if that stock does fall back, okay, back down to 220, I get my 100 shares back again. Or if it pulls back to 230 or 220 and it kind of stays between this range, I get the premium from the call side and I get the premium from the put side. So basically, if I'm in this goal range between my two areas, I get premium from both, which means I get $405 of premium compared to if I only sell the call, okay, I'm gonna make only $200. So that's the big difference is, do you wanna make $200? Or you could make a little bit more. And this is kind of a nice thing to do when the stock is already, you're almost about to get it taken away, right? So you have your 100 shares and they're very close over here. So in that case, so here's your basic covered call. You're maybe a few days into it right here, and maybe the stock is even past your covered call. And now you say, hey, I don't want to miss out. What if the stock goes up another 10 points? You know, maybe it goes up another 20 points. I have no idea. But if we've got this range and you're kind of concerned about it, you could say, well, I'm going to buy the shares, buy more stock, buy more shares. You could do that. But the downside is now you're putting the risk capital on right away rather than letting that stock come back to you. So one of the ways you might get into that strangle is, well, if the current stock price is here, why don't I sell a put a little bit below that? In our case, since nothing has really moved too much, well, I guess it is moving a little bit right now. You know, the stock price is kind of wiggling and then that call is kind of wiggling. So we're making some, I guess, from the days that I moved. But if nothing has wiggled, you could still do this. And you could say, okay, well, I'm willing to take up 200 shares of that stock. So you could sell the put as well. And now what you'll make is 405. So it's basically 2 times your money, but you have to be able to take that risk on that if it does drop, you're accumulating shares. So this is a nice way to do that. And it's also a nice way to do it if that stock is near those highs where you're about to lose your stock, or maybe you're already a little bit past it. And then you could just say, hey, I'll sell the put because if it does go kind of in those lower levels, I'm able to get my shares back at a lower price rather than paying up. You know, at this point, you're going to be buying shares. Like let's say you're going here and this price is at this level. So price goes up, you're at 244. So now if you want to buy more shares, you say, okay, well, I'm going to buy my shares at 244. Well, why would you buy shares at 244? Well, you could say, hey, well, I'll sell a put around 235. And if it comes down to 235, I'll buy the shares at that point. So why not just sell a put there? And that's what we could do. Now I'm going to do this one at 220. So here's confirm and send, put it in the play account, and boom. And now I've got myself a strangle right there. Now this one's in the middle. So if this goes up over here, I lose, okay, my stock at at this price, and I lose my stock by my 100 shares. But I still make money from the premium on both ends. And see, the good thing is I still make $410 regardless. So I'm still making that money. It's just if it goes up there, I lose my 100 shares. But if it goes down here, I'll be left with 200 shares, okay? And because I'm going to get and pick up 100 shares plus the 100 shares. So that's where I get my 200 shares. But if it gets in the middle right here, okay, so if it goes in this middle, okay, then I just keep my 100 shares and I keep the 410. If I don't sell the put, I would only get about that $200 or so. But because I'm selling that put, I make almost double that. And that's how you can really explode your earnings power and potential, by doing both sides of it. Again, I probably wouldn't do this unless that stock was a little bit higher. Like let's say we're selling that call side right here, and that stock is in that upper range, and you're kind of like, I don't want to lose my shares. So what you could do is, sell a put somewhere over here, and then you got a chance to buy those shares at a lower price if it does dip, just in case. So that's kind of one of the ways you might play a strangle strategy and how it might work at a basic level. So I hope you find that helpful. Definitely check out some of the courses we've got on our website, tradersfly.com. And then if you want to do some of the courses, they're all on my Rise, the number 2, LEARN website right here, where we've got like a singles strategy here coming up. By the time you're watching this video, it will already be posted, and you'll be able to kind of stream the videos, because it'll already be pre-recorded. That's a live session. So I hope you got some great knowledge out of this video and session. If you're interested in coaching one-on-one, feel free to reach out, and I'd be happy to kind of work with you, mastermind some things, because I always love talking to smart, intelligent people like yourself. Thanks again. Remember, do what you love, contribute to others, but most importantly, live life abundantly. I'll see you next time.